Hi, my name is Alex He, and our paper explores how the adoption of artificial intelligence technologies impacts the systematic risks of firms. In the last 2 decades, there has been an exponential growth in the adoption of AI technologies such as machine learning, natural language processing, and computer vision. And the central question for economists is how these technologies affect firms' performance. Since there's no public data on AI adoption, our research team developed a novel methodology to measure firms' AI adoption using detailed data on hundreds of millions of online worker resumes. With these resumes, we're able to measure whether a worker's job content involves AI and then identify firms' AI adoption by looking at the number of AI-related positions of each firm. For example, when a firm invests heavily in AI, we will see in the data that the firm hires many AI-related positions like machine learning engineers and NLP specialists. This graph shows that the share of job positions that are AI-related has increased by over 6 times in the 2010s. And we also see that the increase is ubiquitous across all the major industry sectors. Our previous paper shows that following AI adoption, firms have higher stock returns because they do more product innovation and create more and better products. But an open question is, how does AI affect firms' risk profiles? Investors care about risks, and most importantly, they care about systematic risks, which are risks that cannot be diversified away. A firm would have higher systematic risks if the stock market returns of that firm co-moves more with the market returns. For example, when the market goes down, the firm's stock would go down more, and vice versa. In this paper, we consider 2 measures of systematic risks based on 2 classic asset pricing models: the capital asset pricing model, the CAPM model, and the Fama-French 4-factor model. We find that when firms invest more in AI, they experience a larger increase in both the CAPM market beta and the Fama-French 4-factor market beta, meaning that the firm's stock returns co-move more with the market returns when they adopt AI technologies. This is not limited to tech firms, and in fact, our baseline sample excludes tech firms like Meta and NVIDIA. And we also show that the effect is quite unique to AI, and other technologies such as IT and robotics and general R&D investments are not really associated with higher systematic risks. So why is this the case? We show that a key mechanism is that AI technologies can create growth options for firms. In particular, AI leads to more product innovation, therefore creating potential investment opportunities for firms. The finance literature has shown, theoretically, that because growth options are riskier than assets in place, firm beta will increase when growth options become more in the money and decrease when growth options are realized and converted to assets in place. Our empirical results are consistent with the predictions from this mechanism. First, we see that firms' beta increases. Second, the value factor from the Fama-French 4-factor model decreases for AI investing firms, suggesting that those firms are becoming more growth-like. Third, we find that the increase in firms' beta is more pronounced during days when the market is going up or when there's good news about AI, so that the growth options become more in the money. We also considered a number of alternative mechanisms. For example, the AI investing firms may become more like tech firms, which now become a large fraction of the market. They may also have shorter equity durations or correlated investor flows. However, our evidence does not support any of those mechanisms. To summarize, our paper tackles the question of how AI technologies affect firm risks. We find that AI investing firms become riskier and have higher betas, but the higher risk mostly concentrated on the upside, meaning that firm returns are even higher during good market conditions. On the other hand, there is no significant change in idiosyncratic risks or total return volatility despite the increase in systematic risks. So our findings suggest that emerging technologies like AI can not only affect firms' returns and valuations, but also affect their risk profiles.